Hello and welcome. Today we're diving into invoice management. I'm excited to share valuable insights with you. Let's get started. Here's a quick overview of today's session. We'll cover key invoice management concepts, practical applications, and ensure you leave with a strong understanding of the topic. Let's dive in. Before we begin, it would be helpful to review some of the key vocabulary terms that will support your understanding. Invoice: a document detailing a sale transaction, listing items, prices, and total payment due. Purchase order, PO: a buyer-issued document requesting products or services from a vendor, supplier, the company or person providing goods or services. Terms of payment: conditions under which payment is made, for example, net 30 to 10th net 30. Due date: the date payment is expected. Invoice number: unique identifier assigned to each invoice for tracking. Line item: each individual product or service listed on an invoice. Quantity ordered versus quantity delivered. Order is what was requested. Delivered is what is actually received. Unit price: price for 1 unit of a product. Total amount: the total invoice cost. Credit memo: document issued to reduce amount owed. Debit memo: document issued to increase amount owed. Discrepancy: mismatch between invoice and order or delivery. Batch invoice: one invoice covering multiple orders or shipment. Remittance invoice: buyer's notification to vendor specifying which invoices are paid. Tax identification number: business tax number included on invoices, and payment terms. Conditions for payment including due dates and discounts. These terms and additional resources are available outside of this learning module. I encourage you to familiarize yourself and ensure you have a solid grasp of the meaning and application of each of the terms discussed. Now, let's turn our focus to understanding invoice management. Invoice management refers to the structures process by which businesses handle, verify, approve, and pay invoices for goods and services. In large retail or distribution environments, this function is crucial to ensure accurate vendor payment, prevent fraud, manage working capital, and support auditing efforts. Invoice management also involves integrating data from purchase orders, receiving documents, and vendor contracts. There are 5 key functions which support effective invoice management practices. These functions include capturing invoices from multiple vendors. These results may be found in emails, WhatsApp chats, EDI files, and/or portals. Next, there is extraction and digitization of data. This process requires the data to be pulled into the required files format for processing. Once the invoice data has been extracted, invoice line matching based on product catalogs and receiving logs must occur. It is important to note that data must be authenticated or matched prior to proceeding with invoicing. During this process, flagging and approval should take place. Remember, these steps are critical to ensure the data validation is clean. The final function of invoice management involves initiating payment and archiving records. While these functions may sound like a workflow, they are not. They are, however, incorporated into the workflow. This training session is focused on providing background information to ensure understanding of invoice management as a practice only. A detailed training and support of the workflow can be found in another training module. So why does invoice management matter in the beverage industry? First, the high volume and fast-moving pace of deliveries make invoice management a critical need. Then, there are frequent and ongoing promotional pricing and even returns that can complicate records. More importantly, delayed or inaccurate invoicing can disrupt inventory tracking. Stores rely on accurate inventory levels to ensure stockouts and overages do not occur. Above all, most vendor disputes are often the result of invoice confusion or errors. Now that you have an understanding of what invoice management is and why it matters, let's briefly discuss the objectives of invoice management. First, there is accuracy. Accuracy ensures invoices reflects correct pricing and quantity. Next, there is timeliness. Timeliness requires that invoices are processed promptly to avoid late fees and improve vendor relations. Then there is compliance. Compliance ensures an alignment with internal policies and regulations. Efficiency is another goal of invoice management. Efficiency ensures the reduction of manual errors and speeding up workflows. And finally, invoice management is intended to provide reconciliation. Reconciliation allows for the matching of payments to inventory flow and vendor contracts. These objectives work hand in hand with policies and procedures to ensure effective invoicing practices. Scape. Since we have discussed the objectives of beverage invoicing, let's look at the landscape. The non-alcoholic beverage sector is a multi-billion-dollar industry dominated by global manufacturers such as Coca-Cola and PepsiCo. Retailers rely on direct store delivery of DSD models where invoices are generated on the spot within 24 hours of delivery. There are 5 common beverage subcategories. These include carbonated drinks, sports drinks, waters, ready-to-drink teas and coffees, and juices. Examples of carbonated drinks include Coke, Pepsi, and Mountain Dew. Invoice considerations for carbonated drinks should include promotions and seasonal flavor codes. Examples of sports drinks include items such as Gatorade and Powerade. Invoicing considerations for sports drinks include club packs with custom SKUs. Dasani and Aquafina are examples of water products, with mixed sources such as bottles versus club packs being key invoicing considerations. Examples of teas and coffee can be seen in Gold Peak and Starbucks bottles. With these categories, invoice considerations should include size and variation per region. The final category example is Minute Maid and Tropicana. These reflect the juice category and have invoice considerations regarding blended fruit categories with overlapping SKUs. Tasty, the industry is not without challenges. In the fast-paced world of non-alcoholic beverage distribution, invoice accuracy is often challenged by a variety of operational and logistical complexities. Unlike static product environments, beverage inventories are dynamic, frequently shifting due to seasonal packaging, promotional pricing, and stock availability. These variables create vulnerabilities in the invoicing process, where discrepancies between what was ordered, delivered, and invoiced can easily occur. To maintain financial accuracy and vendor trust, it's essential for businesses to understand and proactively address the most common risk factors associated with beverage invoicing. Let's look at the most common risks associated with beverage invoicing. Let's look at the most common risks associated with beverage invoicing. From fluctuating promotional prices to seasonal packaging swaps and even product substitutions, proper invoicing is critical. Fluctuating promotional prices is the first risk factor we will discuss. Promotional pricing is one of the most frequent causes of confusion and error in beverage invoicing. Coke and Pepsi frequently offer time-limited discounts, regional promotions, or combo deal pricing that reduce the price of select items when purchased in specific quantities or with complementary products. However, if the timing of the promotion is not aligned between the vendor and retailer systems, or if the promotional terms are misunderstood, then the invoice may reflect incorrect pricing. For example, a retailer expecting a $1 price for a 20-ounce Coke under a weekly promotion may instead be invoiced $1.25 if the vendor system has not updated the discount or the store's order didn't meet the promo conditions. This risk increases with high-volume orders and across multiple store locations, where each store might run different promotions depending on distributor territories. Additionally, Delays in receiving the updated vendor promotional matrix can lead to invoice reconciliation issues and missed credits. Without proactive communication and system integration, the accounts payable team may struggle to validate the proper promotional pricing, leading to overpayments or delayed vendor payments due to disputes. Seasonal packaging swaps also pose a risk in beverage invoicing. Both Coca-Cola and PepsiCo frequently adjust packaging designs and configurations based on seasons, marketing campaigns, or limited-time events, for example, Super Bowl cans, holiday-themed labels, summer editions. While the product inside remains the same, the external UPC or internal SKU often changes to reflect the promotional packaging. This creates a challenge in the invoice matching process, as these new seasonal items may not be recognized by the store's master inventory list or purchasing system. These swaps also introduce complications in pricing and expected product delivery. A store expecting a standard 12-pack of Diet Pepsi might receive a summer edition variant with a different barcode, leading to mismatches in automated invoice scanning tools. This not only slows down the reconciliation process, but also increases the risk of rejected invoices or short payments. Teams must stay current with distributor updates to track these seasonal transitions and update their internal systems accordingly. Product substitutions? Due to supply chain issues, is a final risk associated with beverage invoicing. Distributors may substitute products without prior notice when an item is out of stock, delivering, for instance, Pepsi Zero instead of Diet Pepsi. While the substitution is often reasonable from an inventory management standpoint, it creates discrepancies on the invoice, especially if the invoice still reflects the original ordered item or fails to clearly document the change. Such substitutions frequently go unnoticed until the reconciliation process, where the quantity and product description no longer match the delivery report. In many cases, the substituted product will have a different UPC and possibly a different price. This makes automated invoice matching difficult and can trigger errors in cost accounting and inventory valuation. If these substitutions are not properly logged at the point of delivery or communicated in advance, they can lead to credit claims, vendor disputes, and inaccurate financial reporting. To mitigate this risk, it's essential for store-level receivers to verify products at delivery and flag any substitutions for documentation in the invoicing system. Turning our gears now to the product structure of both Coke and Pepsi. Coca-Cola was established in 1886 and operates under Coca-Cola Consolidated, Reyes Coca-Cola Bottling, and Coca-Cola Beverages, Florida in all of the U.S. Coca-Cola invoices vary slightly depending on the bottling partner. PepsiCo Beverages of North America operates under Pepsi Bottling Ventures, PBNA, and third-party agreements. Pepsi frequently offers bundle promotions, acresces, beverages, and snacks. Invoicing considerations should account for manufacturer versus distributor billing. Also, internal product codes differ by bottler. For these products, returns and credit memos are issued based on the bill of lading, not an invoice. Beverage packaging plays a significant role in how products are coded, priced, and reflected on invoices. From plastic PET bottles and aluminum cans to larger club packs and fountain syrup boxes, for example, bag-in-box, each packaging format carries a unique UPC and often a distinct price point, even when containing the same beverage. Distributors like Coca-Cola and PepsiCo frequently offer the same drink in multiple formats to suit various retail environments, such as single-serve bottles for grab-and-go coolers or multi-packs for high-traffic stores. This variability in format not only affects pricing and profit margins, but also introduces complexity in product identification and invoice reconciliation. If the packaging type listed on the invoice doesn't match what was received, or what the inventory system recognizes, it can cause delays in approval or trigger unnecessary dispute resolution. Flavor variants add another layer of complexity. Popular beverage brands now offer dozens of flavors, including seasonal or limited edition SKUs that may be unknown to the store's receiving or accounting team. These variants typically have entirely different UPCs, and failure to update inventory systems or UPC master files can lead to invoice mismatches, even when the delivery is accurate. For instance, receiving a 12-pack of Mountain Dew code red instead of the regular Mountain Dew may result in an invoice line showing the correct quantity and price but the wrong UPC. This discrepancy can prevent automated matching systems from validating the invoice, requiring manual review. Proper tracking of both packaging types and flavor variants is essential to maintain accuracy in invoicing and streamline reconciliation. Keep in mind, every product sold in a store, including beverages like Coke and Pepsi, has a unique barcode called a UPC or Universal Product Code. This barcode is what the cashier scans at checkout, and it tells the system exactly what product is being sold, including the brand, flavor, size, and packaging. Behind the scenes, these UPCs are also used in invoices sent by vendors to make sure the store is being charged for the correct items. For example, a 20-ounce bottle of regular Pepsi has a completely different UPC than a 12-pack of Diet Pepsi cans. If the wrong UPC is listed on an invoice, the store might be charged for something it didn't order, or the system might not recognize the product at all. In invoice management, UPCs are critical because they help match what the store ordered, what it received, and what it's being billed for. If all three match, the purchase order, the delivery receipt, and the invoice, it makes payment simple. But if a vendor sends a delivery with a different UPC than what was ordered, or if the invoice lists an outdated UPC, it creates confusion and slows down payment. That's why it's so important for accounting teams and store managers to keep their product catalogs and UPC lists up to date, especially since beverage companies regularly change packaging or introduce new flavors. Without matching UPCs, invoices can't be processed accurately, and this can lead to disputes, delays, or even overpayments. Understand that a UPCA is a 12-digit number that's like a fingerprint for every product. It tells systems exactly what the item is. It's found under the barcode on a bottle, can, or package. This number is made up of three parts. First, the manufacturer code, which are the first 6 digits, tells who made the product. For example, Coca-Cola and PepsiCo each have their own unique manufacturer codes. These codes are assigned by a national registry so that every brand has its own set. Second, the item code, which are the next 5 digits, identifies the specific product, like a 20-ounce bottle of Sprite or a 12-pack of Diet Pepsi cans. Different sizes, flavors, or packaging types each get their own item code. Finally, there is the check digit. This is last digit in the UPC. This is like a built-in error checker. It helps scanning systems confirm the whole UPC was entered correctly. If a digit is typed wrong or a barcode is damaged, the check digit helps catch the mistake. So when a UPC is scanned or listed on an invoice, it tells the system exactly which version of a product it is, down to the size, flavor, and brand. This is why accurate UPCs are so important for invoicing and inventory systems. Before we go, let's discuss the various matching and inventory options available for beverage invoices. A two-way match compares the purchase order, specifically what was ordered, with the invoice, that is what the vendor is billing. If the item, quantity, and price on the invoice match what was on the original order, the invoice gets approved for payment. This method is faster and simpler but doesn't check whether the store actually received the items. It's often used when there's high trust between buyer and vendor or for recurring orders with consistent delivery. A three-way match is more thorough. It compares the purchase order, the receiving report, that was actually delivered, and the invoice. All three documents must agree in terms of item, quantity, and price. This method helps catch errors like missing items, incorrect quantities, or delivery substitutions before a payment is made. It's commonly used for physical goods like beverages to make sure the store only pays for what was actually received. Then there is the four-way match. A four-way match includes everything in a three-way match, but also adds inspection or quality verification, so it checks the purchase order, delivery receipt, invoice, and a confirmation that the product met quality standards. While not always used for beverages, it's helpful in industries where the condition of delivered goods matters a lot, like food service or technical equipment. This method ensures that not only was the item received, but it was in acceptable condition before being paid for. As you have learned, it is extremely important to understand the implication of invoice management and processing for non-alcoholic packaged beverages. There are several factors that must always be considered, with the most important one being knowledge of the product and the UPC. Thank you so much for joining me, and I hope to see you again soon.